Hello everyone, this is Terry with Futures IO, and it's my pleasure to welcome back Dave Force and Darin Newsom with DTN IQFeed for today's webinar, Analysis, Uses of Commitment of Traders Report. If you have questions during the webinar, please feel free to type them into the questions box, and we'll do our best to answer them at the end of the event. Also, if you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. Without further delay, I'll hand it over to Dave and Darin.
Thank you, Terry, and thank you everyone for
get the pop
attending.
Up quick.
Okay.
Right, looking good.
Okay. All right. Thanks again, Terry, and thanks everyone for attending today's webinar, and thank you to Futures IO for giving us this time today. My name is Dave Force. I've been with DTN for over 20 years, and I'll be giving a quick overview of the DTN Market Data Service IQFeed. Then I'll be turning things over to my colleague, Darin Newsom, the DTN Senior Market Analyst, with some very interesting and useful information on the Commitment of Traders Report. But first of all, I do want to mention that Futures IO is the best futures trading community on the planet with over 75,000 members, many of which are IQFeed users. Briefly, in 1984, Data Transmission Network, DTN, started in Omaha, Nebraska, providing market data to area farmers. There have been many changes over the years. The most recent change took place earlier this year with the purchase of DTN for $900 million by a private equity firm based in Geneva, Switzerland called TBG. But DTN is continuing operations from right here in Omaha, Nebraska. DTN primarily has four main divisions. Our original ag division still provides market data to farmers, but now also provides them with in-depth weather and all levels of market analysis, and we've expanded to providing all types of ag data to the complete agricultural supply chain. Our second division is the DTN Weather Service. It not only provides weather information to farmers, but also to the Department of Homeland Security, cities, counties, states, schools, departments of transportation, the NCAA, Major League Baseball, the PGA, the NFL, and many others, with thousands of weather information gathering devices like the one pictured on the side, and over 50 in-house meteorologists. DTN Weather has proven to be faster and more accurate than the U.S. Weather Bureau. With the recent Hurricane Harvey, I've asked one of our weather department representatives to add a few informational slides. First of all, as you can see, weather is important not just to farmers, but also to the energy industry. Airports obviously need to know the weather, departments of transportation for snow removal and road treatment, and even investment companies like Fidelity and insurance companies like State Farm need to prepare for weather events. And of course, sports teams for games and practice schedules. There's a lot of money on the line that can be dramatically affected by making the wrong choice about the weather. Our Global Weather Operations Center is based in Minneapolis, Minnesota. It is manned 24/7, 365 with 50 professional meteorologists. It has been independently rated #1 in accuracy for 10 years running in the US and the last 2 years in Europe, and has shown to be 40% more accurate than our nearest competitor, the National Weather Service. Here are some of the logos of our biggest weather customers, including many states, corporations, colleges, and pro sports teams. Over 30 states and over 1,000 cities rely on DTN weather, especially for winter road maintenance and preparation. Part of the DTN Weather Service includes advanced alerting, We alert the customer via online, email, and text 24 hours a day. The customer can customize what they want to be alerted on and based on what criteria. The name of the weather product is Weather Sentry. It includes real-time radar, hourly forecasts, real-time lightning, customized alerts, among other features. It also includes up-to-the-minute hurricane tracking. Here is one of the hurricane tracking screenshots. This, of course, is a national screen, but you can drill down to your own city block or farm or ball field or wherever you want the radar and satellite shots and forecasts and historical information. Every user has dozens of screens at their disposal to meet their individual specific needs. For more information on DTN weather, feel free to contact Sherry Karstens, who provided these weather slides. Sherry's contact information will be posted again at the end of the webinar. Our third division is our refined fuels. Almost all, over 80% of gas and oil from ground to end user goes through some sort of DTN data processing. And of course, the fourth primary division of DTN, the one that most Futures.io members are familiar with, is the market data division. This is where we cover information on stocks, options, futures, forex data, news, analysis, and coming soon, cryptocurrency pricing. What sets the IQFeed data apart from other data is that IQFeed is complete data. We are one of the very few true tick-by-tick data feeds. Our quotes are direct from the exchange, so there is no middleman or rerouting delay. We have the highest reliability in data because we manage and man 24/7, 365 our own data center with quadruple redundancy and dual ticker plants. So in the event of any type of outage, we can seamlessly keep important data flowing to our customers. Because we have the infrastructure and bandwidth to handle today's high trading volumes, our customers receive the fastest, most complete, and reliable data available. The IQFeed data will feed into 80 popular charting and technical analysis software programs, or you can DDE link the data directly into an Excel spreadsheet, or you can use our API, Software Developers Kit, to write your own custom software program. An IQFeed subscription also includes streaming real-time news from many outside sources and from our own in-house DTN newsroom. In addition to these free news wires, there are many premium services you can add. One of these very popular premium services is the Commitment of Traders Report, which Darin Newsom will be going over in just a minute. But first, I want to quickly remind everyone of the IQFeed special for Futures.io members. Our normal offer is a 7-day free trial with a startup fee and monthly base rate. The Futures.io special, members receive twice as long of a free trial, 14 days, no startup fee, and for the first 3 months, the services are half price. In addition to our fees, there are exchange fees, but the Globex exchange fee waiver program is available to non-professional active traders, so you could be receiving all 4 of the Globex exchanges, CBOT, CME, COMEX, and NYMEX, for just $3 a month total in exchange fees. That's a savings of over $360 off of the full exchange fee rates. And with the Futures.io, remember the first 3 months are half price. Then after that, we offer quarterly, annual, and 2-year discount plans along with our regular month-to-month plan. But be sure to use the special Futures.io link when signing up in order to receive the special Futures.io deal. The link and my full contact information will be listed again at the end of the webinar. Thank you for your time and attention. I'm going to turn over the microphone now to Darin Newsom, our DTN Senior Analyst, and his presentation and analysis of the Commitment of Traders Report. Darrin?
All right, thank you, Dave, and I also want to thank Futures.io for the invitation to speak to everybody here this afternoon. It's an interesting topic. I think it's a largely misunderstood topic when we start visiting about commitments to traders. The weekly reports coming from the CFTC, and one of the reasons why they're so misunderstood, as you'll see here in a few slides, is because there are so many reports. I mean, as I said, you'll be interested when we get to the slide that shows just how many there are. Now, for many of these charts and everything we're going to talk about, I'm going to use corn, but only because I had those most readily available. Again, this is largely an ag unit. I get to study all the markets from metals to energies to financials and so on. But of most interest is usually in this area, at least the corn markets. But the reports that I show you are true for any commodity. So I mean, if you want to know the breakdown of crude oil, if you want to know the breakdown of gold, whatever it might be, situation's the same. Now, I wanted to start this off with by, what is the Commodity Futures Trading Commission? Well, it is the oversight branch. I mean, it's the number one word that I want you to pull out of this slide is to foster open, transparent, competitive, and financially sound markets. And I think it's that transparent part that the Commitment of Traders reports themselves. I mean, this is the CFTC's mission statement, but the Commitment of Traders reports, the breakdown of who is holding what, comes back to this idea of transparency. And it's also, and here's where it really gets kind of fun, it's the idea of creating transparency that really muddies up the waters when we start to look and see how many reports are actually available. Next slide, Dave. And here's again taken from the CFTC website, and this is just, I mean, this explanation of the commitments of traders. You just by reading through this, you'll start to see just how complex this problem, or not this problem, but these reports actually get to be. You have, number one, they come out on Friday afternoons, and it's for the positions as of Tuesday at the close. So immediately, in this day and age of instant information, what we're dealing with is data that's already basically outdated, but it still offers a level of transparency. And then you have all of the different types of reports that are available, from short to long, showing futures or futures and options, or you start to include when you start looking at the the supplemental reports, breaking down into index traders and so on and so forth. And I've looked at a number of studies over the years, and we'll get to my type of analysis here in a little bit. But I've looked at a number of studies, and I've been doing this a long time, and finding a reason to change to many of these different reports, I just haven't found it yet. But it is important because it does show, the reportable positions for commercials, spreading, non-commercials, all of these things. If you're interested, you can break down a market's open interest almost any way you want to, and then start building studies off of that. And that is the great thing about the DTN system. If you go to the next slide, Dave. There is a total, and again, this is just corn. I had to put it on 2 different pages. There's a total of about 50 different numbers, and I don't want to call them reports, but in the one Commitment of Traders report that comes out every Friday, there's 50 different ways of looking at open interest. And, you can, by trial and error, if that's your thing, you can find the one that best fits your type of trading. Maybe you're more interested in index traders, or maybe you're just wanting to keep it as basic as possible, or maybe you want it a little more complex. You want it really broken down. There's something, you can be looking at, like if you go down first part, say you're just interested in flat out futures position. Just go down to first on the left hand side, just the CF_C_CL. That's the commercial long, and just long futures only. If you're just interested in that sort of thing. If you want to bring index traders in, then you go to, I believe, the CI, which is, I can't even find it right offhand. But I mean, they're everywhere. There's a report, there's a number for every type of thing that you want to do. And this is the complicated part. This is where it really muddies. I've visited with folks at the CFTC. This is a lot. This is a lot to handle. And even a lot of my analytical friends, if I talk to 6 of them, they're probably looking at these things 5 different ways. Everyone's got a different take. They use a different thing, which is great because, again, in its complexity, it does provide a certain level of transparency, because you can't. I mean, this open interest, it's going to be broken down, and you're going to be able to use it. You're going to be able to plug it into your DTN with one of these symbols, and you're going to be able to track it. You're going to be able to chart. You're going to be able to plot your trades with it, and there's some good and some bad about that. But by and large, I mean, if the data's out there, we can find it. It's right here, and you can use it. So next slide, please, Dave. Okay, weekly commitments, traders reports. Hit the enter button, please. Again, reports breaks down the open interest held by reportable trader groups. Generally speaking, commercial, non-commercial, spreaders, this sort of thing. And the different commitment of traders reports show different sets of data. Next point is there are 2 main sets of reports, and that is, we've got, next one, Dave. Oh, something misfired here. There we go. Okay, so it jumped on me here. I must have missed a page or something. Anyway, we have 2 main sets of reports, and that is, in my mind, it's the legacy and the disaggregated. In the legacy, it basically breaks the open interest down into commercial and non-commercial. But then, as the industry, the commodity industry has evolved, there were some non-commercial traders who, by way that they established their positions, they came in under the commercial classification. So there was a time in there, probably about 10 years or so ago, that things started to get a little confusing. Let's think about what else was going on about 10 years ago. It was, right around the time of the financial meltdown here in 2008. So there was a need to break this thing down even more. And so CFTC created the disaggregated weekly commitment of traders report. And this breaks the commercial side down into producer, merchant, processor, and user. That's it. I mean, that was the commercial side. On the non-commercial side, you have swap dealers, managed money, other reportables, some index traders, and so on. So it gave more classifications within each one of the 2 major groups. So you could track to see which particular group might have more influence at any one particular time over the market, as opposed to say a commercial, just the flat out commercial side, which really doesn't change its position all that often. Non-commercial side tends to move quite a bit. And I always break this down. Commercial side are those traders who are actually involved in the underlying cash commodity, whereas the non-commercial side are basically just investors, traders, funds of some kind. So that's how I've always broken it down. I've always used the legacy, even after the disaggregated came out, even after all of these new reports came out. It comes under the heading of you can't teach an old dog new tricks. I've built all my studies based on the legacy, straight commercial, non-commercial futures only, to explain why here in a little bit. Basically for ease of purpose. For what I'm trying to do with it. And I know there's a lot of traders, a lot of analysts who like to get a lot more complex, a lot more complicated, but this is how I use it. So next slide, please, Dave. And then hit enter. These reports, again, are released at 2:30 Central Time on a Friday afternoon. The positions that are reported in the weekly numbers are held as of the previous Tuesday. So let's say we didn't have a holiday here, because I don't remember if this thing actually shoots to Monday or not, but let's say the report comes out this Friday. It would be for the close today. So what were the positions held today? Some of the problems that this creates, particularly for trying to trade off of this, is that, as I said earlier, the information, the data is basically outdated upon release. Secondly, because it's outdated and because it's for Tuesday, if you're trying to create correlations with, let's say, the non-commercial long versus weekly closes, it could be skewed. Unless you can break down weekly closes to Tuesday to Tuesday. Because if you start using Friday to Friday, then that's including some of the data that's going to be in the next report. So there's a little bit of a problem there in trying to correlate Friday to Friday closes with Tuesday to Tuesday reports. They don't fit perfectly together, and this creates a slightly lower correlation between a particular study that you're trying to do, a point that you're trying to make, something that you're trying to set up as a signal for trading. It lowers the correlation. It lowers its value a little bit because we're not talking apples to apples. We're talking apples to oranges, which is, again, a Friday to Friday study or chart and a Tuesday to Tuesday report. So we have to keep that in mind. Next, there we go. So this is how I use it. And again, I've been doing this for 30 years. I've been DTN senior analyst now for 14 years. Again, predominantly in the grains, but looking at all markets. And I've developed a way that I like to look at the markets and how I like to use the Commitment of Traders report. So next slide. And it starts off with my basic philosophy of any market, and I don't care, and basically, let me put it this way, any commodity market. When I talk about markets, I'm almost always talking about commodities. But every commodity has two sides. Every commodity market has two sides, and that's, again, the commercial and non-commercial, and this is why it fits so well with Commitment of Traders report data, because we're talking about the same sort of traders. The traders reflected in the Commitments of Traders are the same two sets of traders that every commodity market has. So commercial and non-commercial. And reading the activity of either side, in my mind, has always been, and over time it's been proven to me, it's as simple as looking at trends. I know there's a lot of fundamental folks saying out there it's fundamentals that drive these things. Give me a second here to explain. And all trend is price direction over time. If I want to look at what I believe the fundamentals of a market to be, there are 10,000, if not more, pieces of information every minute, every second, whatever time frame you want to put on it, that's in play, from government policy to world headlines to weather developments to this, that, and everything else. These are all fundamentals. And if you base your analysis, base your trades on that sort of information, you're going to be stymied. You're going to be put into a place where you cannot establish a trade. So what I've used back, for decades in determining what a market's fundamentals are, I don't have to know the particulars. All I'm really interested in is, are they bullish? Are they bearish? Is that opinion of the commercial side of the market changing over time? And to do that, I look at the trend of the future spreads. And that is just the price difference between contracts. So if I want to know if the market is, if commercial side of say the corn market is bullish or bearish going into harvest, I'm going to look at the December contract to March contract spread. In this case, the December 2017 to March 2018, that tells me that it's bearish. Now, does that mean that I know exactly how large the crop's going to be? Absolutely not. But it does tell me that the market players on the commercial side believe there's going to be enough corn, at least short term, up through the February time frame, that there's going to be enough corn to take care of demand. So we can adjust our analysis, our thoughts on the market accordingly, because we have that piece of information. Similarly, I always go back, I believe it was the 2008 crude oil market when we just hit 150, and all the talking heads were yakking on and on and on about how this was going to go to 200, whatever the case might be. If you looked at the spot future spread at the time in crude oil, we were at $1 carry, contango, whatever you want to call it. It's incredibly bearish. The commercial side of the market knew we had enough crude oil. We weren't going 200. Where'd we wind up? Down around 30 by the end of the year. So we can get a better picture, ignoring most of what we hear out there, focusing on what the future spreads are telling us. And then to expand that, we can also look at shifts in the forward curve of a futures market. So if we lay out all the prices together and we watch how that ebbs and flows over time, we can also get a real good idea. And where applicable, which is what the asterisk is for, we can also look at basis, the price difference between the cash market and the futures market. And that gives us a more localized view of what the commercial side of the market is feeling. So again, basically looking at trends in the future spreads for the commercial side. Next slide. So I don't use the commitment to traders reports as much as many other analysts do, some traders do, for the commercial side, because I could sit here and I know there's some value in my the other analyst that we have here at DTN that I work closely with. He does study the commercial side, the change in the commercial position, and he's done a lot of good studies with that. To me, I want to keep it simple. So I look at basically the spreads, knowing that there's probably some important changes going on in the commitment of traders report, but not factoring them into my analysis. Never have, probably should, maybe I will someday. But then on the non-commercial side, that's where it changes a little bit, because when I want to know why a market's moving, and honestly, that's the question that analysts get asked more than anything else, and that is, why is a market moving at any particular time? What we can look at is to me, it's the non-commercial side that moves a market more than the commercials. Now, the commercials can set the opinion of the market as far as fundamentals go, as far as long-term supply and demand, again, bullish, bearish, neutral, whatever it might be. But it's the adjustments week to week, month to month on the non-commercial side that actually gives us the trends. So how do we follow this? And again, the non-commercial side are traders who are not actively involved, in my mind, in the underlying cash commodity. That's my simple definition. And to do that, I look at the trends of the futures markets to know how their mood is changing. And I base this off of Newton's first law of motion, which paraphrased is a trending market will stay in that trend until acted upon by an outside force, with that force usually being non-commercial activity. So if we have a trend that is active, moving, market's probably going to stay in that trend until we see some sort of change in the non-commercial activity. Now, next slide, please, Dave. Again, keep it simple, stupid. That's my message to me. I use the legacy. So my analysis is based on the legacy report. I'll use the short form, which basically just shows me futures only, and I'm looking for the non-commercial traders. Because ultimately what I'm wanting to do is is to show, at least again with whatever correlation there might be, the tie between the non-commercial activity and the trend of the futures market. So that's where, in my mind, that's where, in my analysis, that's where the commitment of traders reports comes into play. Hit enter, please, Dave. And this is, again, a corn chart. I could have used crude oil. I could have used gold. I could have used just about anything. What I want to look at here is the blue histogram. Part of this is the corn's CFTC non-commercial net futures. Okay, and again, this is reported every Friday as of the previous Tuesday. The black line is probably the more important line for what we're talking about here today. The green line is DTN National Corn Index. That's National Average Cash Price. It's important, not necessarily so important right now. So let's focus more on the blue histogram and the black line, which is the weekly close of the most active futures contract. Now, this just goes back to 2006. I could really compress this and show it further back. But again, you can see the correlation that I've always looked for. You know, tight, wide, whatever it might be, but you can see the relationship between, if you look over there in April 2016, when we had a lot of non-commercial money rushing into the corn market, we pushed the corn futures up to a high of about 440, weekly close only, and then what happened? Non-commercial traders started getting out. Their net long futures came down to the point where it actually went negative. In other words, they were net short the futures market in say late July 2000. That would have been just the summer of 2016. What did the futures market do? As we go along day to day, week to week, we see that the market is trending, and knowing that there is this solid, who knows what, I don't know what the numbers of correlation is. I've run the numbers many times. It always changes. But that there is a good correlation between non-commercial activity and what the futures market is doing. When we're asked what's going on in this market, without knowing what's going on in the spreads, and I can tell you it was getting more bearish at the time, so the commercial side was getting more bearish. We also know that the non-commercial money was coming out. That money coming out created a downtrend. That downtrend resulted in the futures market from falling from 440 down to 320. Okay, so now, after the sell-off, we started to see non-commercials build their position back up again. And we saw the market rally back up to about $3.80 to $4. And then an interesting thing happened. The non-commercial side did move back into a net short, but the futures market didn't react very much over the early summer of 2017. And it was only when non-commercial came running back into the market that we saw the futures market spike again above 4. Now, the last 5 or 6 weeks, we have seen that net long position of probably 175, 180,000 contracts. Again, very basic, legacy, short, futures only. 180,000 contracts, whittled back to about par. And the futures market fell from about 410 back down to about 350, lost about 60 cents. So the fit is there. I mean, and so when I get asked, when I write, when I'm analyzing, and I see that the market has developed a downtrend, I usually phrase it as, non-commercial traders are starting to sell. One of the reasons they might be starting to sell is the other side of the market, the commercial side, if the future spreads are bearish. But if the future spreads start to turn and they start to turn more bullish, that's going to pull that's one of the triggers that tends to bring non-commercial money back in. So the non-commercial side eventually follows the commercial side. So the trend in the futures will eventually be moving the same way as the trend in the spreads. And we can track that, again, particularly on the non-commercial side, by looking at the weekly commitment of traders report. Next slide, please, Dave. Okay, here's just the analysis of what I just talked about. So we can go to the next slide. Again, I want to note we can note the correlation between the blue histogram and black line. Despite the slightly different time frames, it's still a fairly tight correlation. When not, and then again, just basic, when non-commercial net long decreases, futures tend to trend down, and when non-commercial net long increases, futures tend to trend up. So again, the next slide, please, Dave. Okay, now that was laid out against the futures market. Now this is just, I just pulled, there's a lot of ETFs out there. I just pulled the Tukrium Corn Fund. It's one that I happen to track. And what you can see is that the correlation between overall non-commercial futures position and the and a particular ETF isn't as strong as just the futures market. And I found that interesting. There's still a bit of a correlation. You know, if we go back into mid-2015, we see the spike. The futures market was rallying. The fund was following along. And then, you know, the fund and futures were coming down, and the non-commercial position decreased down to a net short again. Similar scenario, mid-2016 got a rally. Again, the fund price spiked, and it's only really been since about the middle of 2016 when the fund just flattened out, and non-commercial traders have been doing a lot of things. Now, this could be a couple different things. Number one, the general tendency of corn is to trade sideways, and so the fund price might actually be reflecting that more so than just nearby futures. You can see some wilder swings. Whereas with I believe this one averages out like 3 different contracts, and so you're going to flatten your price out a little bit. But I mean, there's still a correlation that looking at the corn market, crude oil, gold, whatever it might be, through a different lens rather than just flat out futures market versus one of the funds that's most likely included in the report itself. So not as tight of a correlation, but still, if you're wanting to look for possible turn points, reasons why the market's turned, notice again there's a lag, excuse me, between what you see in the price and what eventually happens in the fund in the non-commercial position. So I found it interesting to overlay that one as well. So next chart, please, Dave. Again, this just runs through that. All right, and here we go. Here's another look at it. And this is taking, again, when I said that the commercial side tends to move. So now you're going to have to use some of the old proofs that I can't even remember the right course. But if we use the non-commercial position as a stand-in for the futures trend, because remember, in the very first slide of these comparisons that I showed, that was with the futures market. Remember that there was a tight correlation. Now this is the futures spreads for corn. So notice that there's even a greater lag. So you notice the peak in early 2016 in the future spread, the nearby future spread, and it was well after, weeks after, if not months, that the fund position changed direction. So we saw the commercial side move from bullish to not as bullish to neutral down to bearish. And that's when the non-commercials finally said, we're not going to fight the tide of gravity here. I mean, if the commercial side's saying, this thing's bearish, we're going to start getting out. And likewise, when the spreads started to turn back up, it wasn't as much of a lag, but there's still a little bit of a lag once it hit the bottom. Again, look at the peak in late 2016, flattened out a little bit, but the non-commercial position continued to grow. When it broke pretty hard. Now, if we look far off to the right, this is probably what's a little bit concerning. Yes, we've whittled the non-commercial position again down to about par, but the future spread, the nearby future spread, again, the D March, is still pretty bearish. So, it looks like there may be a little bit more liquidation. I know we're coming up on a time of year here when harvest is just around the corner. We've actually, if I recall in the last report, we might actually be looking at a net short position at this time. So it's going to get kind of tight. And I think at that point, when we move net short, that's when I think this market's probably going to get ready to turn around, because I don't know how much, I don't know if we want to build up the same sort of net shorts that we've seen the last couple of springs. It's possible. And if we do, most likely, again, we're going to see the futures market continue to go lower. All right, next slide, Dave. Again, the chart analysis of that. Note the relationship again between the non-commercial and the commercial. There's a lag where the commercial side leads the non-commercial side. We could track that again with the commitments to traders report. So next slide, please. Okay, I guess that's my look at it. So at this time, I'm going to open it up to questions for Dave, for myself, anything about IQFeed, anything about DTN, anything about the commitment traders reports, the way I look at them, the way I use them, the way I analyze them.
Okay. Let's see. Do you think the approach in Larry Williams' COT book of about 10 years ago is still good for interpreting current COT reports?
I'm going to say I'm not familiar with that particular book and the analysis that was in it. I know these things are ever evolving. I say that, and I'm still talking about the things that I've done for the last 20, 30 years. So, I mean, if it worked for Mr. Williams at that time, the general theory, and again, I not having read it, not having it in front of me, I'm not going to say absolutely, but the general theory probably still holds true, even though we have changed the number of reports, the breakdown of these reports, and so on. We have to take that into account.
Okay. Let's see. Aside from commodities, what about financials and other intangible assets, e.g., equity indices or interest rates? Is a quite. Sorry, I'm trying to.
Yeah, I'm sorry.
I'm trying to read the question so I can figure out how to have it worded.
Okay.
What can the COT tell us about equity futures? And is it different from commodities, in your opinion?
It would be different from commodities, but I think the general message is the same. I don't know that, you wouldn't necessarily need the breakdown of traders, probably going to be a little bit different between commercial and non-commercial. Number one, you'd have to understand that sort of breakdown. But if you're just looking for a confirmation of trend, which is again the reason why I use, or the purpose for my use of the commitment of traders report, if you're looking at equity futures, you could probably get the same sort of information by through the commitment of traders report. It's not something that I use a lot. I don't venture outside of the commodity sector all that much, but I'm sure that you could at least take a look at it. Might find that it's not overly useful once you get into equity futures, but again, you never know, particularly with the way the markets have changed.
Okay. My question is on the weather aspect and information. Dave, can you talk a little more about that? Like, I guess, how does it work as a trader? Like, what can I gain by DTN's Weather Service?
Yeah, the weather is probably not as important for individual traders as it might be for like an insurance company that has to prepare, or Obviously, Department of Transportation has to put down chemicals and how much they're going to spend on this and that, or if they're going to have practice on the, if it's too windy or too, so it's probably other industries. I suppose if you're trading maybe, like orange juice futures, obviously the weather is going to play a big part in that. But I don't think as an individual trader, you're going to probably not use the weather as much as, somebody with a lot more responsibility.
Dave, I'll just jump in and add 2 cents on this one as well. The current, the recent weather development certainly plays into this. With Hurricane Harvey that we saw move across, and if you're using your DTN weather and you're getting a more reliable forecast as to when this thing's going to hit, where this thing's going to hit. I mean, we all saw what happened in the RBOB futures where they just skyrocketed. We all knew it was coming. If you're going to threaten Houston and its refineries with a hurricane, and our forecast is going to give you a better, when and where and how bad is it going to be. You can jump in on that sort of thing. Now with Irma coming around, what we've seen in cotton has shot limit up today. Okay, why was that? Okay, number one is the damage from Harvey. It's the potential damage from Irma. But we also, as Dave pointed out, orange juice skyrocketed. I remember back 25 years ago when Andrew was getting ready to hit Florida, and it was another Category 5. It wasn't with DTN at the time, but there were traders out there who made the correlation between, Andrew's going to hit Florida, lumber futures are going to take off. So, you can use better, more timely weather information to look at some of these markets that you have a good idea are going to be affected by very short-term weather events. Try to get yourself in position. So just in the last couple of weeks, we've seen this thing play out a number of times.
Okay, thank you. The guy has added a bit to his question, so I'm trying to figure out how to ask this again. He says, in a quite classical hedge long-short model, when I'm bullish on stocks or sectors, I'm probably short the ES and S&P and vice versa. Is this visible? I'm assuming using the COT.
If the position's large enough to be reportable, it would be visible. And that's where some of the gray area comes between what's commercial and what's non-commercial, because if it's considered a hedge, a hedge of another position, that might fall under, in the simplest, in the legacy model, that could very easily come under the hedge of a commercial when actually there's nothing commercial about it. So yes, now if it's not large enough and it's not a large enough group that's doing that, then that's going to fall under the non-reportable position, which is a very general classification. But yes, if it's a large group and it's a large reportable group, in the legacy, that would probably come under a commercial position.
Okay, perfect. Thank you. My next question is on David talked about a bit about DTN's data feed being dang, I can't think of the term now. I lost the term. Being a pure data feed, not being
true tick by tick.
Yes, true tick by tick. Can you explain to some new traders what that actually means?
That means that we receive from the exchange and we send out to our customers every tick and every trade that happens, whereas a lot of data feeds will consolidate the data and they might send out information 3 or 4 times a second, where when depending on what your charting is doing, you're going to lose maybe half of the data if they're only reporting part of it or only reporting it on a refresh cycle. Whereas with our data, you're going to receive every tick, so your charts are going to be more accurate than if you're just using something that doesn't show every trade.
Perfect, thank you. If you have any other questions, please feel free to type them. If not, I'll give them a minute or so and then we'll wrap it. Do you ever see the non-commercials leading price? And if so, is there any consistent reason for that?
I think here's where I kind of sit on the other side of the fence from most folks is I think the non-commercials actually do lead price. I think the trend in the futures market, and most people say no, these funds are just trend followers. I believe they're trend setters. So I do believe that, again, if we were to compare the futures market, on an even basis, Friday to Friday, or on a Tuesday to Tuesday, I think what we would see would be even a better picture that non-commercial activity actually leads price rather than follows price. And I think part of that again is the timing difficulty. Now both of those tend to follow again what's seen on the commercial side. So I think price can be pushed one way or the other by non-commercial activity. Then ultimately has to get back in line with what the underlying fundamentals are.
Okay. Do you ever see it the other way where it doesn't lead price? And if so, is there a reason why?
It can happen, and in those cases, and I think if we just go back to that corn example that I showed, where the price really wasn't reacting to the non-commercial side, and it's because we had other things going on in the fundamental in the commercial side of the market. And so I think what caused that, what happened there was the price wasn't reacting to non-commercial activity as much because of what was going on. It was one of those transition periods where what was going on in the commercial side actually offset anything that was going on in the non-commercial side. So it was an interesting time, particularly this last spring and early summer in corn, some of the other grain commodities, ag commodities, and we've also seen it recently play out in cotton, where some non-commercial activity might not actually be showing up in price. And again, I think it was because we had a very bullish situation in the fundamental side, in the commercial side, that was offsetting possible pressure from the non-commercials.
Okay. Hi guys, I think that's it for the questions. Thank you for the information in the webinar, and most importantly, thank you for your time.
Thank you. Can I add one more thing, please?
Absolutely.
All right. Yeah, in case anybody is currently an IQFeed subscriber, you can add the Commitment of Traders report on a free trial basis. If you're not an IQFeed subscriber and you sign up for the IQFeed free trial, you can add the Commitment of Traders report to that free trial. And the report includes several years of historical data. So if you wanted to do any kind of back testing, you'd have that ability to do that without actually signing up for the premium service. And it's just a $25 a month add-on after that if you decide to keep it.
Okay. If you have any more questions or comments, you can see on the current slide Darrin and Dave's contact information. Please feel free to contact them and they will take care of you.
Great.
Hi guys, thank you for the webinar, and y'all have a good evening.
You too. Thank you.